2026 is shaping up to be one of the best years ever for Canadian natural gas stocks. Today, I'm going to talk to you about 3 specific bullish reasons, catalysts that I'm buying this year. We're going to start with the Twilight of US Shale. Eric Nuttall put this really well on his Twitter in the last week. This big story came out about Harold Hamm, legendary US wildcatter, cutting production growth in the back end, meaning he's not drilling any more wells. And this is the first time in 30 years that he's not had a drill in North Dakota, which is a huge shift. And it represents a sentiment shift from American energy investors. The US actions geopolitically have hurt all energy markets, right? There's been this serious effort to keep oil prices down short term. And what that's done is drop energy production. And don't take it from me, take it from the EIA. If you look at what these guys put out literally the other day, they're talking about the fact that low oil prices will weigh down US production. They are expecting to see low oil prices throughout the rest of the year. And you can argue with that, right? Lots of very smart money is arguing that they don't think that's going to happen. Actually, they think the market's going to be more receptive. However, low oil prices in the short term are certainly weighing down US production specifically. The WTI Brent differential is surprisingly wide right now. It's been up to as much as $6 over the last little while, meaning that US producers specifically are getting hurt additionally to what everyone else is getting hurt. That speaks to a general trend in declining growth in the Permian, declining growth in the back, and declining growth in all these US shale basins. And that leaves a huge opportunity for Canadian natural gas, because as oil prices start to weigh down US producers, the competition for natural gas starts to go away. And natural gas will move slower. I need to be clear on that. Just because oil wells and oil-rich wells are declining in a lot of these basins does not mean that the natural gas associated is necessarily declining at the same speed. You're actually seeing more gas short term. But as less wells are drilled, that means in the next 18 months, you have 6% less competition. Then the 18 months after that, you continue to see the snowball grow and grow and grow until such a point where there's like serious undersupply, and we're worried about even fulfilling all of these AI data centers and these LNG facilities that represent gigantic growth in natural gas demand. Is that necessarily going to happen? Who knows? Likely we'll see higher prices promote more drilling, but the fact is you need to see higher prices for that to happen, growing huge free cash flow opportunities for Canadian producers. On top of the free cash flow story, we also see a massive amount of merger and acquisition investment dollars flowing into Canada. Now, this has happened in deals like the Ovintiv NuVista deal that we saw last year, where this major American producer decided that they wanted to buy up Montney assets, and they went and found one of the highest quality, smaller cap Canadian producers, bought them out. But we're also seeing Canadian dollars flowing into these natural gas forward basins. Specifically here, we see Canadian Natural, CNQ, buying out Tourmaline's Peace River High assets. If you don't follow these companies all that well, that basically means that Tourmaline's buying out about $1 billion chunk of Tourmaline's business in the Peace River, where Tourmaline was kind of pivoting away from. It's a region of the Montney that they're pivoting away from, and they're focusing on sort of their core basins and focusing on consolidation in those areas. So we could see this $1 billion either get deployed into new acquisitions or get deployed into some sort of shareholder focused return, maybe paying down debts. Maybe it's going to, replace some of the capex that they were going to do. Who knows? Either way, bullish for both CNQ. They're getting this new asset. I think it's a high quality asset. And of course, bullish for Tourmaline in the shorter term, where they do need a little bit more cash. And a lot of investors have said, hey, we'd love to see maybe a higher free cash flow yield. This could be the opportunity for that. But still, it represents a trend. It represents a trend of more and more money valuing the assets that these companies hold, meaning that over time, as you see prices getting set by these deals, it starts to speak to what the whole company is worth. Because if you argue that the Peace River High assets at whatever price that they end up settling at, and we'll see that come out in a news story in the future, well, if you look at that price and you look at the amount of production that those assets produce, that now sets the baseline for what those assets are worth. And then you start to look at the companies, the equities in the space, and you see companies like Tourmaline trading for far lower than what they just sold their own assets that they are running at. Interesting opportunity, in my opinion. We then jump into the LNG story. And this is such an interesting story because there's sort of 2 facets here. The first facet is talking about expansion. We've got 2 major projects here in Canada that are likely to get FID'd within the next couple of months. And I cannot emphasize how massive this is. First, LNG Canada Phase 2. We're likely to see that later on in the year. I would expect, a Shell-led group maybe goes for that, or you could even see some switches in ownership. I know we've seen some big money moving through the space and taking a look, and some of these producers are looking at different areas. So you're going to see some sort of decision made on that. It could be huge. We're already seeing Train 2 coming online after a lot of challenges, power-related challenges and stuff going on there over in Kitimat. But with Train 2 coming online, we've seen a really strong price and a really strong price sort of futures curve here in North America, and particularly in Canada, where we haven't necessarily seen that strength coming out of the winter in the past. We're also seeing a huge opportunity coming out of the sort of opportunity for direct supply. Obviously, there's a couple of companies that directly supply these projects. They're getting priced a little bit higher. They're looking at the sort of future pricing they're going to be able to command, and it looks really awesome. Investors love to see that. These two major announcements are going to move the needle on these stocks. I sincerely believe that we're going to see Silisms come through. I've been told it's supposed to be first half 2026. I don't know how truthful that is, right? I think the fact is that there is a lot of moving parts to this, so maybe it comes even later. But still, those two FIDs, final investment decisions, meaning that these projects go from, we're planning on doing this to, money's on the table and we are building now, that will change the future for Canadian natural gas. Because as we've already seen with LNG Canada, setting a baseline price is a gigantic shift in how this market works. Instead of having these times like we had in November, where you can see Canadian natural gas drop to the negatives or to the tiny pricing, instead you're going to see a solid, consistent demand constantly on the table at all times, thanks to these LNG facilities. On top of that, the US LNG buildout has been exponential. Gigantic amounts of US LNG capacity are being built by lots and lots of different companies along the Gulf Coast. And there are a lot of Canadian producers between, the C&Qs, the big guys, and all the way down the list that are really, really excited about this, because this also then provides more demand for their competition. You can argue that maybe these producers will directly supply these facilities. And for some producers, that's huge, because Canadian producers have way longer reserve lives than their American competitors. So if you're building a facility that needs 20 years of supply, it makes a lot more sense to look at a Canadian producer as part of your mix. Maybe not all of it, because then you have to pay to transport it, obviously, reducing your sort of arbitrage, your margin there. But if you make a deal like we saw C&Q make, like we've seen guys like ARC make, where you're supplying a certain amount over the long term, that is really beneficial for both parties. And you're going to see more of those deals signed in the next year. I really do believe that as you start to see pricing go up in the States, go up here in Canada, that dollar difference that you might see on the transportation cost is not necessarily going to be quite as big a barrier. And you could see more American LNG facilities looking towards Canadian producers. You could also see them looking towards maybe American producers who are moving into the region, which they already have contracts with, because those American producers buying up Montney assets or other Canadian assets with longer reserve lives could then supply a longer term return. All in all, very, very bullish for Canadian natural gas producers. And then you get the extra sort of added cherry on top of little projects coming online, the wood fibers, the cedars, right? These smaller projects that still offer huge amounts of growth. And that's when you step into the data center story. And I think this is so interesting because natural gas power generation went from impossible to possible over the last couple of months here in Alberta specifically. And you've already seen billions and billions of dollars allocated. And while we can have a huge argument right now about whether or not it's a good thing long term for these data centers to be built, it has been heralded as the second coming of the oil fields by regions here in Alberta. A lot of folks are looking at the jobs coming in. A lot of folks are excited about the opportunity, and there is real money. We've got European money coming here. We've got US money coming here. We've got Asian money coming here. Like all over the world, there are people looking to take advantage because of AECO pricing. The same thing that made Shell so bullish on LNG Canada is making these natural gas data centers much more attractive, because that AECO pricing is so opportunistic. Like the fact you can get even $1 cheaper than NYMEX, North American general sort of US natural gas pricing here in Canada, makes it even more sense. And then you look at how that all stacks up and how that changes the story for companies like Tourmaline. And I know we talk about Tourmaline a lot, but seriously, this is the name brand Canadian natural gas stock, the one that most generalist investors invest in. For the last decade, the story for them has been about growing production at a reasonable price. It has been about, playing this amazing Montney play producing whatever the highest value product they could make, marketing it well, selling it internationally, selling it to the United States, and hoping for cold winters. But now the story is a multifaceted bull run with massive AI data centers, with massive LNG demand, with growth in natural gas power in general to supply power to all over, with a massive shift in the understanding about how these data centers and how these LNG facilities change the natural gas landscape long term, sort of a shift from this like 10-year bridge fuel thought of natural gas to this, 25 plus year. I mean, Japan is planning to use natural gas past 2050. That changes the game. And yet, if you look at pricing, where is that reflected? And that's in the biggest name, the one that generalists know. Move down the list in market cap, but not in quality. ARC, Pado, and all of the other guys in the money. There's a lot of really high quality stocks. We've talked about them a lot. All of them have that same opportunity. Each of them is going to play it a little bit differently. And those different ways they play it will reflect the kind of production you see in the stock, the kind of free cash flow you see returned to shareholders, all these different things. But all of them benefit from this gigantic trend, and almost none of them are priced like it, which means the opportunity is definitely still there. 2026 could be a gigantic year for these stocks. As we see all of these bullish ideas, these catalysts come to life, there will come a moment when the street recognizes just how valuable the production of these companies is, and it hasn't happened yet. So what I've done for the last year is dollar cost average. I've been buying over time. Have I made a huge amount of money short term? No, but that was never the point. The point is that as I buy, maybe it'll take 6 months for the market to come around, maybe 12, maybe 18, maybe 24. But I will watch all of these bullish catalysts. I will see as the market shifts and adapts. I will see as announcements are made, projects are started. We will see the demand growth. We'll see the associated sort of free cash flow return, the disciplined capital operations of these companies, and there will be a tipping point. And I'm so excited to see how it plays out and what happens. And so this is where I drop the question for you folks. What do you think about the opportunity in Canadian natural gas in 2026? Are you as bullish as I am? Do you think I'm missing important factors? Drop your comments in the comments down below. If you watched this far in this video, you like what we do here on the channel, please do like the video. If you like watching these Canadian topics, talking about these different stocks, please do subscribe. And I hope I see you in the next one.